The following is a presentation of TFNN. Now, TFNN opens the door to the future. Larry Pesavento, systems analyst, is your tour guide into the market futures. Want to see into the future? Well, climb aboard Larry's time machine and come with us. Larry takes your phone calls. Now, toll free at 1-877-927-6648. Internationally at 727-445-1044. This is the Futures Hour. Here's your host, Larry Pesavento.
Okay, good afternoon, folks. And I'm going to start the show with American Barrick because we spent a lot of time on that stock yesterday, and because it's related to commodities, because it's the largest gold miner here in the United States. It had a really nice move early this morning of about 1.5. It made the first profit objective because we were only risking 66 cents on that, and now it's come back to exactly what we paid for it. The key here is that it cannot go below that low that we made just a few days ago. So the risk here is right at $16. In other words, it cannot go below, let's say, $16.05, $16.10, because we bought it around $16.55. At least that's what our recommendation was, and we got almost to 17 today, early in the morning, and then, of course, it's backed off a little bit, so we'll have to wait and see. But it's very important that once they break these support or resistance spots that we look at, that they'll usually go to the next level. That's why you have to pay close attention, at least from a risk management frame of mind, to where these things must hold. So 16 is pretty much etched in stone here in American Barrick. Now I'm going to switch over to the gold market, and we'll take a look at this, and you'll see here that we have a pennant forming, a really symmetrical pennant. But what's interesting about this, that if you look at it going back from about the middle of March, you'll notice that each of the rallies that we've had has been a 786 retracement of the previous rally, and that was true this morning. Yesterday we made a low right after the Fed meeting at 1282. We rallied a little over $2,000 up to the 1304 level, and then the market, which was exact 786 of the high we made last week, coming in off of 1312. So it still has a bias to the downside. We've had lower tops all along in the past month, but we've also had higher bottoms. Here go. That's why we have this pennant that is forming. Usually pennants will continue in the direction of the long-term trend, and if you look at the long-term trend here in gold since last September, we've been in a decided downtrend. We did have the big ABCD move that have finished around January, where we had a really strong rally of well over $200 an ounce. But since that time, we've been drifting lower, but very, very low volume. I mean, there's just lack of interest in this market. It's just, not doing very much at all. So that's the key to what we're looking at today in the gold. Now, the other thing that I wanted to mention that I think is very important, and that is the fact that we have been watching the potential for an island top in the market for the New York Stock Exchange Index, and that number that we had today has since touched. In other words, we have touched the low of what we had way back on that 2 weeks ago in August, not August, but on May the 12th. The low of that day was 10,640, and we've gone up to 10,656 today. So that tells us that this island reversal that I was looking at, the island has been sunk. So there's no island reversal there. We do have, I'm going to post that in just 1 second, just as soon as my computer gets up and moving here. You'll see that we've gone and touched that area right here. So my assumption is that if this isn't a head and shoulders pattern, the market's probably going to go up and make new highs sometime before the holiday. Now remember that historically, on a statistical basis, the market has a tendency to close higher on the day before a holiday about 75% of the time. The Memorial Day holiday is Tuesday, so Monday has a really high probability of being a up close. How much it is, I don't know, but just it says that usually the day following or preceding a holiday is quite strong with a high probability of closing higher. The highest day of all, of course, is the day before Thanksgiving, which is shortened hours, but it's still the strongest of all the holiday days, and then also the Christmas Eve one. I guess it's due to the festive atmosphere of the holidays that we have. I'll spend just a couple seconds here going over the VIX index because everyone's, trying to bury it. And all I know is that this thing always raises its head. We're trading below 12 now, folks, in the VIX index. We haven't been this low since last January, and this past January. So whether that's going to mean anything or not, I don't know. But in the past, it always has. I have put a lot of emphasis on the fact that we've had so much margin debt, and usually there's only been 5 or 6 times in my trading history when it's been this high, and every time it's ended in disaster. Whether it's going to occur or not this time, we'll have to wait and see. But the VIX index is certainly down to lows that we haven't seen since last year in December, and it just continues to drift lower with very low volume and total lack of interest by the trade as far as fear. And believe me, the VIX index has a pretty good indicator for, fear and greed. I'm spending a little more than 5 or 6 seconds, but I just wanted to just to show you where we were on a weekly basis when we talk about fear and greed. We'll take a look at this because what happened during the too big to fail propaganda stuff that we had in 2009, when the market was making all-time lows on the downside. We were trading around 650, I believe, in the S&P, and the 60. I forget the actual number in the Dow Jones. I think it was. I don't want to. I know the S&P was around 666 because that was a 618 off the low from 1982. So anyway, that's what we're looking at in the VIX. This thing will turn, but it hasn't turned yet. There's just no reason for anybody to have any fear in the market at all, because it just doesn't look like it wants to go lower. Now I wanted to switch over to the soybean market. By the way, folks, today at the break we're going to have Rich Anderson on from Anderson Capital Management to talk to us about the grain markets and also the cattle market, because cattle, if you're a beef eater, folks, or you're in for big, you're looking at prices that are going to be high for a very long time, because we've got feeder cattle in an area that haven't been there for a long time. And to add a little more fire to the inflation, we're having a really strong breakout today in the soybean market, and we'll ask Rich to talk about this when we come on. So we'll see. I believe that someone said that the markets were closed both Monday and Tuesday. That cannot be, because in the Constitution it says that we cannot be closed 4 days in a row, as I recall. I believe it's in the Constitution, or it's someplace up there, way up in the importance of things, because of the fact of the international banking, that they keep it open. The only time that that's happened was when we had, well, it happened during World War II, of course, but then it happened during 9/11. We were closed for, I believe, 7 days during that time, when I think, gosh, it's been so long ago. God, can you believe it's been 14 years? Oh, my God. Anyway, that's what's happened with the markets. They don't usually close 4 days in a row, so they keep it open. I believe that the actual holiday is on a Tuesday. Is the holiday on a Monday and not on a Tuesday? I checked on the Google last night, and I'll double check that for us before the end of the show, but I'm pretty sure that the closing day is Tuesday. That means we might have a very lightly traded New York Stock Exchange session on Monday, because I know the folks like to get out of town, out of New York, which is certainly understandable. So we'll wait and see. Anyway, the soybeans, we've had 5 straight days now of very strong action, where the beans have moved over 60 cents per bushel, which is equivalent to $3,000. And with a really strong movement that we're having today, we're up well over 25 cents. It looks like things are, moving, strongly to the upside. The real surprise in the commodity markets, from my perspective, being in them for, 6 decades, is the fact that, you know, we're looking at feeder cattle at 200. I mean, that's just amazing. The last time I looked at them, they were around 65 or 70, and now they're at 200. Rich will explain to us what this means to us longer time, because it takes 14 months for the gestation period, you know, for a calf to get it to market, and so, or to, you know, to have it born, and then you've got another 8-9 months to fatten it up and get it out, and it's really amazing. Last night at dinner, we went to one of our favorite Italian restaurants here in Philadelphia with the children and everything. It's a really fun place, and we've known them for a long time. And I ordered veal, and the veal was much smaller than which was a custom. I was expecting to see that, and but I was just truly amazed that the portions have gone down so much. And I asked the owner about it, and he said, that's my only alternative. He said, I have to cut back portion sizes. He says, because I can't raise prices. He said, it's I pay $22 a pound for veal, and he said when you pound it out and everything, it's still, you're just barely making money on it when you serve it. So you just get ready, folks. We got really high prices coming down the road to the next 12 to 18 months. In both hogs and cattle, and so get used to eating chicken and learn to eat carbohydrates, because those are the few things that are at least not too expensive right now, especially rice, which has been one of the staples across the world, of course. But the grain markets are really starting to move. Now we're even starting to having a move in the corn market. I'm going to bring that up here for just a second and go over that with you to show you. We're going to be looking at December corn, we're going to be looking at July corn, first of all. Now, it hasn't moved at all compared to, just one second here, you'll see it hasn't moved at all compared to the soybeans, and nor has wheat. So that's a good thing. So it could be that the soybeans are just a special situation, but I'd be looking for a spot here to go long corn, just on a seasonal basis. The reason why is the corn has been planted now. They're starting to plant most of the beans, and there's never been a year that I can ever remember, and I'm going back 5 decades now, where we haven't had at least 1 or 2 crop scares, either too much heat, too much water, too much cold. It's always something. There's usually 2 or 3 of those every year that end up being anywhere from $1 to $2 a bushel, which is $5,000 to $10,000. During that time. So, we had a really big butterfly bottom in the corn, back in January that we were able to take advantage of. The market rallied, well over $6,000 a bushel over the next 4 months, and now we're having our first serious correction in corn, and so far it's only down to the 382 level of the low that we made in January. So this is the spot where I'd be certainly looking to take a nibble on corn from the short side. Whoa, from the long side. Let's put it the right way anyway, if nothing else. So that's one of the things that we want to keep watching on. The stock market continues to go higher. The Dow's up about 14. The composite's up about 22. And we've got gold and silver up a little bit. So 877-927-6648.
TFNN is excited about our new software charting program, The Art of Timing the Trade Charts. In collaboration with Tom O'Brien and using his best-selling book, The Art of Timing the Trade, Your Ultimate Trading Mastery System, David White has programmed an outstanding piece of software that will complement any trader's methodology. Using this first-of-its-kind program, The Art of Timing the Trade Charts allows you to scan thousands of stocks for Fibonacci formation setups, including Gartley's, ABC's, butterflies, and much more. The Art of Timing the Trade Charts is designed to help you when scouring the markets for stocks just beginning to form the trading patterns that many investors spend days, weeks, or even months searching to find. And right now, we're offering licenses available at only $79 a month. We are so confident that you're going to love this new charting software that will even give you a 30-day unconditional money-back guarantee. Don't miss out on this incredible new piece of software. Get your copy of The Art of Timing the Trade Charts today by visiting TFNN.com.
Wouldn't it be great if you could get a red light, green light indicator that gives you signals on 25 different future contracts? Now you can with Taz Signal Box. This red light, green light market profile system dynamically updates 24 hours a day and provides you with important trend and trade signals on 9 different commodities, 9 different indices, and 8 different currencies. Right now, you can receive a free 2-week trial to Taz Signal Box. For all the details and to find out how the Signal Box works, visit the front page of TFNN.com.
Andy Hecht has just announced a live 90-minute webinar that he'll be hosting Saturday, June 7th from 9:30 till 11 a.m. Eastern Time, entitled Energy Opportunities During the Summer of 2014. With the frigid winter having depleted some key energy stockpiles, Russian political tensions high, and the storm season for the Gulf setting up to reverberate through energy markets worldwide, opportunities could present themselves over the summer months that could provide huge payoffs. When you sign up, you'll gain immediate access to a 7-page report Andy has put together as an introduction to what he'll be covering, so you can start preparing and get a feel for what Andy will be discussing live during the workshop on Saturday, June 7th. Andy will be advising his attendees of at least one trading recommendation in each area, including crude oil, natural gas, coal, and refining spreads and oil products. The best part is that this live 90-minute webinar is only $99. Don't wait. Sign up today and reserve your spot while gaining instant access to Andy's 7-page report right now. For all the details, visit the front page of TFNN.com. You take a hands-on approach to managing your investments, and whether you're bullish or bearish on Chinese stocks, the ETFs from Direction Shares are there to help you magnify your perspective. Bull ETFs for a rising market and bear ETFs for a falling market. Direction Shares gives you the tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor Foresight Fund Services, LLC.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen live during those shows, and have access to all those charts. You can test drive the Tiger's Den absolutely free for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com. Larry takes your phone calls now. Toll free at 1-877-927-6648. Internationally at 727-445-1044. Now, back to the Futures Hour.
Okay, we're back, folks, and I posted into Tiger TV the chart for December corn. It's called Christmas corn, as you can imagine, when you're down on Florida and Chicago. And basically, that's the corn that they're planting now. That'll be harvested in October and November. And so what I'm going to do is I'm going to make a recommendation here. Back in January, when we were making that butterfly bottom down at the 430 per bushel, we had a really nice strong rally. And now we're pulling back to a 61% retracement down here around the 468 level. We're trading around 471 right now. So I'd be willing to buy Christmas corn down here at December corn at around 468 a bushel. That basically puts you as a farmer. You don't have to worry about owning the land. You don't have to worry about the loan at the bank for your seed and your equipment. You don't have to rent or lease the equipment or anything like that. You're just going to buy the Christmas corn, 5,000 bushels, which is a couple hundred acres, and then you're going to hold that, and hopefully we'll keep it. Hopefully is a terrible trading word, Larry. Let's change the word. We will look to see if the market will give us a good rally sometime during June, July, or August as we run into the growing season. So we're going to buy December corn at around the 468 per bushel level, and we're going to risk 20 cents on that. So that's $1,000. So we're going to put our stop down around the, from 40 is 20, so 448. We're going to put a sell stop at 448 per bushel. So that's basically what we're looking at. So we'll see. I have, going back to the question that we had about the market, I have it official that the stock market is closed on Tuesday. I'm not sure about Monday, but the official close on the stock market is showing at the NYSE as of Tuesday. The commodity markets, they might close early because they don't have the same constraints that we have with the Federal Reserve, with the stock market and the bond markets. And I'm sure the banks are closed on Tuesday. I already saw that. So the 27th is the holiday. I imagine it's going to be a slow day on the 27th because most of the folks will be out of commission. I'm certainly going to be doing very minimal work at that particular time. So I enjoy the Memorial holiday very much, and that's one thing, folks, that I really highly recommend that we try to remember the veterans that we've had that take care of our country. I was unable to be a soldier, thank God, because it was Vietnam. I would have been the first to go, but because of a that was a Freudian slip, it was probably right. No, I have a physical disability. I've been deaf since birth in my left ear, and so I was unable to go in the service with a 4F classification, but I've done everything that I possibly can to try to help the folks. I'm a big promoter of the Wounded Warrior Project, and also anytime I have a chance to train someone to be a trader that happens to be a veteran, I always donate all the all the materials and all my time to try to get them to to be a trader. And I've been really fortunate to do probably half a dozen of those over the years, that been able to help them quite a bit for all the things that they've done for us. My father had 5 brothers, and the 6 of them were all in the service during World War II, and then also in Korea. And I had 2 uncles that were also in World War II, but I was unable to go. My 2 first cousins one was at Annapolis, and ended up being a Navy SEAL, and the other one was with the U.S. Army, and both of those had I forget what they call it. When they first lieutenant, right out of school, they were into Vietnam, and they were both killed in the first 2 weeks. So it was quite sad. But anyway, we'll forget about that and go on to the next market. Okay, so we're going to be buying corn. We're going to have a break here pretty soon. We're going to buy Christmas corn at $4.68 a bushel. Put on your farming hats. We're going to put a sell stop at $4.48 a bushel, risking $1,000 to be a farmer. That's all you have to risk. You don't have to watch the crop. You don't have to do anything. You just walk in and see what's going to be trading at, sometime in September, and we'll keep an eye on it as we go through the shows here. But it's a very good risk-reward ratio. It's a valid Gartley pattern here. You have everything. You've got the trend turning to the upside. You have the seasonals in your favor. All the things say that it should work, but it's just a probability. That's all it is. Nothing more, nothing less. So just like if you were buying it down at 4 something a bushel back in January when it was oversold, it's the same type of thing here. It's only a pattern. That's all it is. Okay, we got the Dow still up on the day, and gold and silver up slightly.
If you're an active trader looking for that extra edge when it comes to trading and investments, then now is a great time to get a 2-week free trial to Tom O'Brien's daily market letter, Market Insights. Tom O'Brien's daily newsletter, Market Insights, comes out every market day at around 9:30 a.m. and provides Tom's daily commentary on the broad market, including the Dow, NASDAQ, and S&P, plus specific trade recommendations. There's even an update published most afternoons to keep you informed about the day's market activity. He'll give you the entry price, price target, and stop price of each stock in option trade. With Market Insights, there's nothing left to guessing. For all the details and to get your 2-week free trial to Market Insights started today, visit TFNN.com.
Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors. The Path of Least Resistance is David White's daily trading newsletter, and if you're looking for active trading ideas, then now's a perfect time for a 30-day free trial to this powerful daily trading advisory service. David uses his years of trading experience to offer his subscribers his trading ideas each morning in his Path of Least Resistance newsletter. Using a combination of equity trades along with options, David keeps his subscribers up to date with all pertinent market information with intraday afternoon updates when warranted. Don't miss out on this great chance to get a 30-day free trial to David's daily newsletter, The Path of Least Resistance, with no obligation to pay anything. David has been delivering solid recommendations for his subscribers recently, and if you'd like to see the type of newsletter he delivers every morning, then visit the front page of TFNN and you'll find The Path of Least Resistance under Trading Newsletters. For all the details and to start your 30-day free trial today, log on to TFNN.com now.
No matter where you listen to TFNN programming, we want you to know you can always access your favorite shows on demand through TFNN.com. TFNN airs live programming every market day from 9 a.m. till 6 p.m. Eastern, and you can view each program by accessing Tiger TV through our homepage. We even have an easy link for all mobile devices, including iPhones and iPads, located at the top right-hand corner of the TFNN homepage. You can use your smartphone to view Tiger TV, but if you don't have a mobile connection that can keep up with streaming live video, then you can simply visit TFNN.mobi in the browser of your smartphone for live streaming audio of all of our programs. The mission of TFNN is to educate our audience directly and interactively through our interactive website and radio call and talk shows. TFNN is able to teach all levels of investors the technical skills needed to trade in today's marketplace. In order to get the best information possible, TFNN has assembled the most respected financial minds in the country to provide the most current news and comprehensive advice available. TFNN.com. Educating investors. This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com. Now, back to the Futures Hour.
Okay, we're back for the Futures Hours, and I believe we have our good friend Rich Anderson from Anderson Capital Management on the line. Rich, are you there?
You bet. Hi, Larry. How are you?
I'm hanging in there. You know, every day above ground's a good day. Rich, I've got a question for you that someone asked me about 4 or 5 days ago, and I hadn't been able to reach you to get the answer because I wasn't able to answer it. We have, I think, over 3,000 different commodities, as I recall, that are listed and traded on these 8 or 9 different exchanges that we have. But, you know, frankly, I only follow about 25 or 30. Rich, as far as the volume on some of these, I mean, some of these must be pretty slim, aren't they, as far as volume and liquidity?
I mean, and that's not just true of, I mean, you really have to look at volume when you're looking at futures contracts. I mean, even let's say even within the soybeans, which there's a lot of volume in soybeans, but if you're in the wrong month, there might not be adequate volume. I mean, if you're planning on being in it for a month, no problem. But if you're planning on being in it for a day or two, there might be 2 cents as the cost to get in and out, the spread between the bid and ask, and you just don't want to be in that. So I look for the highest volume markets. There are some markets overseas that have high volume too, but I don't even, you know, I figure you've got to be good at just a few. It's too hard to be good at all of them unless you're running a computerized program, and that I'm not. So I stick with the high volume markets, and if you get good about one market, you can make all the money you need to make. But there are some European markets, but this isn't this having liquidity and volume. That's not just an issue for futures markets. That's also an issue for ETFs. If you get into the wrong ETF, there might not be the liquidity to get out. And the true cost, your true expense in trading, is not just the commission you're paying, but the difference between the bid and ask. And if you're in an illiquid market, whatever it might be, whether it be a futures contract or ETF, it's going to cost you more to get in, and it's going to cost you more to get out. So I always look at the difference between the spread between the bid and the ask, and look at the depth. You know, how many are being bid for, and how many are being offered, and what's the volume. And if it's below, actually, you know, I don't like to trade any market that's below 5,000 contracts.
Oh, that's ridiculous. Sure.
I
Rich,
mean,
do you remember going back
hundreds of thousands, euros, you know, I mean, beans, grains, you know. So there's really very little need to trade things that don't have enough volume, because if you're a good trader, it doesn't matter what the market's called as long as it has liquidity. You know that.
Oh, sure, yeah. Well, we've been through this we've known each other 40-some years, and I remember in October of '87, on the 19th, we were both in, I had some options on, because I had rolled over just one unit. Most of my options expired on October the 16th, that Friday, but I still had one for November, and the spread on that option had 20 handles on it. Usually it was like a quarter of a point.
Right.
And there were 20 handles on that spread, and I was never able to get out of it because there was no one on the other side. The other guy just wouldn't move, whoever it was. There were more than several, I imagine, but there was just no liquidity on that day. It was just absolutely scary.
I mean, and I had a friend the same thing happened to. The market was bid 12.5. He put an order in to sell it at 12. Doesn't get filled. At the end of the day, he goes to market and gets a quarter to a half under the low of the day.
Yeah.
And you know, I think the low of the day is 3/4, and he got a half, and he complained. You know, it was his own account, and he was a broker, and he complained for all he's worth. But you know, the market
doesn't help.
They just cease to exist.
Yeah.
You know,
Rich, I have a question on this is one of your favorite subjects, I know, and that's we're in the meat market here. We've got feeder cattle up at around 200. I never, ever in my lifetime would ever think we would see feeder cattle. Would you explain to the folks what's going to be happening to them over the next year on the price of meat? You know, because how this whole thing goes from feeder cattle to live cattle and stuff. And could you give them an idea?
So if you buy a typical load of feeders, if you buy a semi-load,
tell the folks what a feeder is,
heads.
Rich, just to be sure. Give them an idea of what a feeder is, okay?
Okay. So a feeder is a calf that's been weaned off its mother and probably fed some pellets so it's weighing the futures contract is roughly 750 pounds. So it's they're usually born in the spring, and some calf in March, some calf in April, some early birth calves in February, but then you got to deal with snow, but then it can snow in April too. So they're about getting towards the yearlings, they're getting towards a year old, and they'll put them on feed, and then it takes, they'll gain on average 2.5 to 3 pounds a day. And the mercantile contract for live cattle, which is the fat cattle, when they've been finished feeding, is roughly 1,200 pounds. Although that you can have them up to 13. You know, there are some variances, and
Italian cattle always weigh more.
Well, I'm sure there's an Italian cattle breed, but I'm not familiar with it.
I was being sarcastic.
The best breed of cattle that I thought, as far as a breed joke goes, was Merrill Lynch was always bullish on America, and it was a Mexican Longhorn that they used for their ad.
Oh, sure, I remember that. Yeah.
But there are some European breeds that are bigger boned, and they were getting up towards 1650 to get them finished, to get them enough fat on them. But the packers these days really like these cattle about the same weight, so that when they go to to butcher these cattle, and they cut them up these days and put them, in slices into the containers in cartons. In the old days, they used to send half of they slice them in half, and so half of the carcass would be be hanging on hooks, and they'd send them to the grocery stores, and the butchers at the grocery stores would cut up the pieces. Nowadays, the packers actually cut them up at the packing plant and ship them in boxes, and of course they can get a whole lot. It's much more efficient. So then the packers are looking to buy the fat cattle from the feeders, and if they're all, they get premiums. If they're guaranteed Angus cattle, I'm going to get a premium of a couple bucks, and they're going to want them to be a specific weight, and a specific size, so they'll fit in those boxes that the containers that they ship them in, because the big cattle aren't going to fit. But if you got regular sized books, and then you got some big books, the big books aren't going to fit in the box. So that's one of the reasons. Like the cash market is probably right around 144, and the June cattle are 137.50. And the obvious thing is, well, how can they be, 6.5? And that 144 is down $2 from last week, I might add. How can they be $6.50 under cash? And the reason is because if I'm feeding guaranteed Angus cattle and I've got a contract with a packer, I can't push them. In the old days, we'd push them ahead and we'd sell them in May and get that extra $6-7. But now they have to be a certain weight in order to get those premiums, and your premium might be as much as $2 more. But you've got to sell into that time slot when you've committed to deliver them, and that's why the basis is getting so out of whack. And we have just the opposite thing in the hogs. Right now, the cash market's roughly 112. The June board is 117.92 right this second, down $2 today, and it's you would think that they would be selling less because these hogs are relatively high, that they'd be pushing them towards the July contract, which is 126.
Rich, how long is it going to be before we get some relief on lower price meat? I mean, we're looking at, it looks to me like at least a year before we have any hope of lower price meat.
Well, the October hogs are $20 cheaper, and the December hogs are 95 cents are $30 cheaper than the July. So, by fall winter they should be a lot cheaper. The reason these hogs are so high is because we had this PED disease, and when the babies were born, they would just die. If the pigs got it and they were 40 pounds or more of weight, they'd get sick, but they wouldn't die. And so you would have these farrow to finish operations where they're farrowing pigs, and all of a sudden their sows get sick, and they have no pigs for 6 weeks. I mean, because any babies that are born, they die. It's just the opposite in the cattle. This shortness is because we've had this significant drought in the Southwest, in Texas, Oklahoma, going into Kansas, and a lot of these feeder cattle are put on pasture because the cost of gain is so much. It's maybe 40-50% of the cost of gain of feeding them to grow them rather than just putting them on grass. But the grass has been so scarce because of the drought that we've had down there that most of them are what's called background. They're fed stuff rather than just putting them out on the pasture, and then that's your cheapest gain. You can put on a pound of beef for from 700 pounds to maybe you take them up to $9.50, and that gain's going to cost you maybe 50 cents a pound. Whereas if you're feeding them, that gain's probably going to cost you maybe $1.25 with these prices because of it's just expense. I'm hearing some news, and I'm personally not friendly to the cattle market right now. I'm hearing some news that's I can't talk about, but it's bothering me. So all I'm saying is that I'm staying away from the cattle market right now. It's just there will eventually be an explanation for why these cattle are so much cheaper than the cash, but a lot of it has to do with that most of the feeders are tied into a certain packer, and they're feeding for that extra $2 premium, and they only get that premium if they deliver in that time window, and it's usually a couple-week window, and so they can't move them forward to get that extra money right now, which is unfortunate. But You know, when markets get overextended, all of a sudden, you know, they kind of falter, and then there's just one more straw that breaks the camel's back, and who knows?
Always the most bullish
what
at
I'm
the
hearing
top
would
and
be
most
more than
bearish
a
at the
straw.
bottom.
So I'd be standing offside on the cattle market for now.
Okay, Rich, what is the reasoning for the strength in the soybeans today, you know, being up 25 cents? That's quite a move in beans.
Well, we've got like 24 vessels coming from South America to deliver beans. Basically, in this country, we've sold more beans than we've got. You know, so they've had to actually import beans from South America to make soybeans last through our new crop. Mm-hmm. Now, the interesting thing is that, and the real head scratcher today is, how can November beans be up to 21 cents when, you know, if you don't get the corn planted, which in the western corn belt, which I would consider Minnesota, South Dakota, and in the eastern North Dakota is kind of the western corn belt, which isn't a big production of the part of the production of corn, but it's still significant. You know, we've had a lot of rain to deal with, and we're just getting behind. And over in Indiana, I was just talking to my guy that shares my office, and they're having to replant some of their corn because they had 6 inches of rain. But the less corn you plant, the more soybeans you can plant, because land's expensive these days, so you can't afford to let it just sit there. And so while the government, USDA, is forecasting like a 330 million bushel carryout for next year, a lot of the commercials and professional analysts are talking that we could have a carryout of 450, which would make new crop soybeans, be worth, you know, $9-10, not $12.75. But November beans are tied to the July. If you look at the July-November bean spread, right now we've got 15.25 and 12.74. Just rounded it off, it's roughly 250, and 250 is an awful wide spread. And the November's not going to let go of, you know, it's being pulled up by the July. Basically, what I'm telling you is that the November beans are being pulled up by the July, and until we get enough of these boats in from South America, we're not going to see any relief out of July.
Rich, you ever think we'll see $20 bushel beans?
Say again?
You think we'll see $20 a bushel beans?
Well, I don't, but I have friends that are telling me that that's possible. I mean, these boats that are coming from South America, they have to, you know, get to the right port because they don't, not all the, I mean, just as we're talking, the hogs just dropped another 50 points. It's like, you feel like, you know, somebody pokes a hole in the balloon and it starts to leak a little, and then all of a sudden, but they get, these boats, not all the ports can unload these boats, so they got to go to the right port, and, you know, they got to be in line. And
sure. Hey, Rich, we're going to come up to a break
here. When the July gives up, the November is probably going to be a ideal short, provided that there's no weather problems, because at this point there are no weather problems once we get the stuff in. But there also is a very big drought out in California. You know, the heat out in California, and that tends to move its way east as you go through the summer, and so we'll see. We'll see.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads.
Tom O'Brien's weekly gold letter, The Gold Report, gives complete and concise coverage of the entire gold market. Inside, you'll get Tom's commentary on gold, the dollar, the rand, the bond, the XAU, the HUI, and detailed coverage of nearly 25 mining stocks. He'll give you the entry price, price target, and stop price of each stock trade. The Gold Report is a long-term newsletter where the focus is on building real wealth through the management of a successful portfolio of gold stocks. With a lifetime of knowledge and almost 12 years of writing his informative weekly newsletter, The Gold Report, Tom O'Brien can provide you with the important market information to help you make better trades in the gold market. Don't let the next bull run in gold pass you by. To get a month-long free trial to The Gold Report, an $85 value, visit the front page of TFNN.com today.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
We're told to follow our passion and everything else will fall into place. I hope that's what each of you are doing each and every day. Hi, I'm Steve Rhodes, host of the Money Master Show at TFN.com, and my passion for technical analysis is what led me to the most fundamental discovery in pattern recognition, the Rhodes Momentum Indicator, market scanner, and trading strategy, a set of tools that identify the momentum and power of the trend, the likes of which have never been seen before, for every market and every time frame. Yes, folks, the trend is your friend, unless you're on the other side. New to technical analysis? This is the place to start. And experienced traders, take advantage of the trend like never before. Experience the power of the Rhodes Momentum Indicator each day, available to subscribers of my newsletter service, Mastering Probability. I guarantee your satisfaction for the next 30 days unconditionally, so there's no risk to you other than being on the wrong side of the trend. Mastering Probability, available on the homepage of TFNN.com. And folks, live with passion.
Up next, the Diagnostics Trading Hour with Daryl Martin here on TFNN. Now, back to the Futures Hour.
Hey, welcome back. This is Rich Anderson. Larry apparently has lost power. We were talking about the cattle and the hogs, and I would definitely be thinking about staying away from the cattle market. But a couple of other interesting situations is this drought in the Southwest. It's impacting mostly the Kansas City wheat. The Chicago wheat is soft red wheat, and actually Kansas City wheat is now trading in Chicago too, and that's a hard red wheat. So if you're going to look at the long side of the wheat, you look at Kansas City, and we've had a pretty good sell-off in here, but that's the one to be trading from the long side. And then on rallies, you look at the Chicago. If you look at spreads, you'll see that that certainly has widened out. There's been an interesting, yesterday the crude oil market rallied, and the gold and silver didn't, and I thought that was kind of an unusual anomaly. I'm kind of looking at the crude oil to find a reason why the drawdown was a abnormal thing, and looking for it to be fully priced in here, and I will probably play that with spreads. That's how I trade markets that I'm not watching, that I'm not actively trading. The other markets that I'm watching closely are the gold and the silver. If you look at platinum and palladium, they both made new highs above March, and the gold and the silver just sit here muddling around. Now maybe there's been there's too much open interest in the ETFs, and that's what's the drag on the gold and the silver. But I'm watching those closely because I think the platinum and the palladium are giving you a clue that there's interest in these metals. And the question is, do we have inflation or do we have deflation? That's what the economists have been talking about lately, and that's yet to be cited. But we still have an awful lot of money in the system, and as long as that money's in the system, I expect the gold and the silver will pop up. The Chinese are spending lots of money in this country on real estate, but in their own country, living ostentatiously is frowned upon, and so what they're doing is they're buying jewelry and stuff like that. The Indians had tried to slow down the purchase of jewelry in their country, but with the new Modi as the new prime minister, they'll probably look to stimulate the economy in India, and I think they'll be back to being a major buyer, because those two countries are major buyers of the actual product. I'm thinking those things will be the things that, if your technicals give you a signal, you go with them. I try and get macro ideas of what's likely to cause something, and I look for the technical reasons to set up. That's what Larry taught me years ago, and that's what I still do today. And it doesn't matter whether it's a stock, an ETF, a spread like Kansas City, Chicago wheat, or July, November beans. All these things I trade technically, and the technicals work on spreads just as well as they do on outrights and just as well as they do on stocks. I think those are some of the interesting situations I'm looking for. The bond market, it's had a big rally here earlier in the week, and it's come off. I don't really see interest rates going a whole lot lower, but many people are talking about, well, we're tied to Europe, and so we're going to have to go lower. We shall see about that. The euro has rolled over. That's another one that once you get a currency trending, they tend to trend for a very long time because the government has made a decision in the central banks, not unlike when our central bank made the decision, when our Federal Reserve made the decision to pump money into our economy. And that money has certainly helped anybody and everybody that had money to invest in stocks, but the people that paid the burden of that were the savers who get virtually nothing for the money they have invested. Well, I hope Larry will be back in the next week and talk to you. Hope you trade well and make sure you control your risk. Take care.
Since 1984, Basil Chapman has been using the Chapman Wave methodology to advise traders of his expert market opinion. While originally hand-drawing charts from the late 1970s into the 1980s, Basil noticed that prices under most circumstances virtually always had a certain number of legs to the upside before declining sharply. Later, Basil found that computer software, which included the standard market technical indicators, enhanced the degree of accuracy in calling price turns, as well as market trend calls. Thus was born the Chapman Wave sequence. Using the Chapman Wave methodology along with other indicators, Basil Chapman advises his subscribers of his expert market opinion each market day with his opening call newsletter. Right now, you can get a 2-week free trial to the opening call, Basil's daily trading newsletter, by visiting the front page of TFNN.com. Cancel at any time during that trial and pay absolutely nothing. Get your 2-week free trial to Basil's newsletter, The Opening Call, today by visiting TFNN.com.
You're watching Tiger TV.